In this short lesson, we're going to talk about how you can use the VIX to increase your confidence in your trades by holding positions for a longer period of time, as well as one of the easiest trades you can take in the market. Although not everyone's going to be able to do it, there is a few workarounds we'll talk about towards the end. So the first thing is traders often have a hard time holding winning positions. Meaning, if you get this gap down buy Monday on SPY, how do you know to hold this all the way back through here? The first thing is we understand that if it doesn't reverse, it's still going up. So every high or low in here just tells you it's still going up until you see they come back in off all-time highs. Now, the second thing is we can use the VIX. So when this gap down buy occurs on Monday, January 13th, if we go to the VIX at that time, you see the VIX is really obviously coming back the other way. And what the VIX will do is it will spike up and then it will revert to the mean, which is normally around like 15 bucks. Historically, it's more closer to 19, but we've had some lower VIX environment. But you can see they're pretty much spiking up, going back down, spiking up, going back down. The only way the VIX can go up forever is if SPY goes to 0. So therefore, it's always going to come back down unless the market's something, crazy happens. That being said, when we see our actionable signals, our reversals coming back the other way on the VIX to the downside, we can expect the market to firm up. So when this goes to the top of the broadening formation, gaps up, and then starts coming back, we can expect the market to firm up. And the VIX try and go back to the lows here, which it ends up doing here. And you'll see they spike it up again, new highs, and then come back towards the lows. And they gap it up, bring it back to the lows. So this is constantly happening. So the first thing is whenever you see a big upper wick forming or that has formed, that's normally a hint that they're not that scared. When you have long green bars closing out the highs, normally that means things will continue. The second thing is, do we want to trade the VIX specifically? Probably not. They price in a lot of this. But since we can use that, and this goes red, starts coming the other way, we can expect SPY to go the other way. So unless the VIX starts firming back up by going 2 up, we can expect the SPY to keep going. And therefore, we can use this to time market tops and bottoms by combining the analysis. So like in this example, Friday, December 20th, it gaps down and goes green on SPY. How do we know we can buy that? The first thing is SPY is a gap down buy. So it's going selling, gap down. Normally when that occurs, they're done selling. The same way when this gaps down, they're normally done selling. So we can then go to the VIX and see, is that confirming that? So we can see here on Friday, our actionable signal on the VIX is what? The inside bar up, that goes red here as a rev strat. So when that occurs, we know it's going back down there. So if the VIX is going to drop 16%, the SPY should go flying, should it not? Yes, it should. So you'll notice how they're going to confirm our analysis, or sometimes they'll negate. Like if it gaps down and the VIX is still going up, but SPY's flat, normally they're scared. You might not see a big buy coming. So hopefully that makes sense. The other thing then is the easiest trade in the market. It's shorting the UVXY. So the UVXY tracks the VIX futures, which means they're buying and selling futures contracts. And therefore, since they have to roll them over and you have something called contango, when this occurs, it's always going to go back to 0. So this is going to be the best short in the whole market. You'll see it's just constantly, it started 90 million. There's a lot of stock splits, but these are real moves, right? You're going to see how the UVXY drops 46%. See, it drops 64. It just keeps going down. So since we know that occurs, when the VIX spikes and then we see the market start firming up, we can look for the broadening formation to go back the other way. So in this example, if we go right to left, you'll see we made the slight higher highs here and the lower lows here. When this goes rev strat, pivot machine gun, this is a great trade, right? You'll see it drop 16% in one day. That's something we want to know about, right? And once that occurs, it almost never comes back. So when you get these nice big higher highs, they almost never come back to it. And therefore it's the best short in the market. It always goes to 0. The worst thing with this is it's hard to get shares. Like you have to borrow shares to short it. And therefore it may be a little bit more difficult to do. There is options. They will price in some of the move, but I can tell you, if you can anticipate it dropping from here to here, you can still make money on the options. And the same thing is true with the VIX, the VIX. And one of the most profitable trades on the VIX is anticipating when it's turning around, up or down. The way we do that is, again, by using the SPY analysis, but how does the VIX go up? It goes up when the indexes are in a period of full time frame continuity down. So this big rally in the VIX, this was something we were talking about when the VIX was down in here, is coming back through. How do we know that? Well, the first thing is the broad information, right? We're drawing right to left, the slight higher highs, the slight lower lows. So when this starts getting through here, that triangle's kicking in, right? Potentially they're back up there. So that would be a big move. Now, what's going to confirm that? If SPY is full time frame continuity down, so you can see they bought it Monday, bought it Tuesday, and then Wednesday with the news, they came and bought it again. If we go in there, as around December again, you can see while the VIX is going up, SPY is sideways. So they're slowly buying the VIX before this news comes out. Then we get the 3. We go to the weekly. This occurred 2 down week with full time frame continuity because at that point the month was red. So every group was hitting the bid. So when that occurs, the VIX will spike. And this is how we can anticipate to close short positions if we short the VIX, or how we can anticipate to go and buy the VIX calls, which when you're playing the 0 DTE or the weeklies, they can have really big price gains, but we just can't hold on to losers. So very important. But hopefully this is starting to make sense. Now, the same thing is true, right? If we have full time frame continuity up, that's when the VIX goes back down. So if we draw out the monthly open here, you're going to see this. The first gap down by the month was green. Then we had some red, which is where the VIX starts coming back the other way. And then gap down by again, the month is still green. We still have this period of control with the month, the week, the day. So when we go to the VIX, looking at that same thing, you'll see February opens, it's red. So it's completely opposite. And then there's some buying of the VIX in here, the slight higher highs, and then triangle back down. So hopefully this is all making sense. These are some of the coolest things that you can use in your trading tool belt in order to increase your likelihood of success, hold winning positions longer by seeing is the VIX actually coming back or is it still 2 and down? And hopefully this is going to help you guys out. If you have any questions, DM me on Twitter, or again, I have this new topmate.io/Alex'sOptions. If you go there, you can send me a DM for free and I'll respond to it. So if you have questions, always go and check with me here. I can get back to you hopefully within a day. Now, that being said, that's all I've got for you guys. Hopefully you guys enjoyed. I'll see you guys in the next.